Investing just $500 a month could make you a millionaire. Here's the exact math. See why starting at 25 versus 35 creates a 300K plus difference, and where to start today. Investing just $500 a month could make you a millionaire. Here's the exact math. We break down compound interest in a way that finally makes sense, show the shocking cost of waiting 10 years to start, and tell you exactly which platforms, Fidelity, Vanguard, Robinhood, to use to get started today. Fidelity, zero-fee index funds, excellent for beginners. Vanguard, lowest expense ratios, the gold standard. Robinhood, easy entry, fractional shares. S&P 500 index fund. Compound interest explained. Compound interest explained. $500 investment millionaire. How to invest $500. Investing for beginners. Fidelity versus Vanguard. S&P 500 index fund. Start investing at 25. Compound interest calculator. Robinhood investing. Index fund investing. How to become a millionaire. Wealth building. Passive investing. Long-term investing. The Wealth Blueprint. Background. Black with a bold gold stock chart shooting upward from left to right. Left side of the chart, small figure of a person with $500 label looking small and uncertain. Right side of the chart, same figure, now large and confident, with $1 million in oversized gold numbers. Bold text overlay at top, how $500 a month becomes $1 million, in white. Bottom corner, small text, the math nobody shows you. $500 a month, that's 2 car payments. That's a few nice dinners. That's a gym membership you might not even use. It's also, if you start at 25 years old, worth over $1 million by the time you're 65. I'm going to show you exactly how that math works because once you see it, you cannot unsee it, and it will permanently change the way you look at every dollar you spend. Here's the uncomfortable truth. 57% of Americans are not investing at all, not even a dollar. And the most common reason isn't lack of money. It's this. I'll start when I have more. More money, more knowledge, more time, more certainty. And every single year they wait, the most powerful force in the known financial universe is working against them, instead of for them. That force is compound interest. And most people hear that phrase and tune out because nobody's ever shown them what it actually looks like in real numbers. That changes right now. Simple interest is a flat line. You put money in, it earns a fixed amount, nothing changes. Compound interest is a snowball rolling downhill. Your money earns returns. Then those returns earn returns. Then those returns earn returns on returns. It feeds on itself and it accelerates over time. Let's make it concrete. You invest $10,000 at 8% annual return. After year 1, $10,800. After year 5, $14,693. After year 10, $21,589. After year 20, $46,610. After year 30, $100,627. You didn't add a single dollar after year 1. That $10,000 turned into over $100,000 purely through compounding. Your money literally made money while you slept, while you worked, while you lived your life. Now imagine what happens when you add to it every month. Here's the simulation that should make you pull out your phone and open a brokerage account right now. You invest $500 every month starting at age 25. You earn an 8% average annual return, conservative, based on historical S&P 500 data adjusted for a diversified portfolio. Let's watch what happens.
Age 25, $0. Age 30, 5 years in, $36,983. You've put in $30,000, but you already have $7,000 in returns. Age 35, 10 years in, $91,473. You've contributed $60,000, but you have over $31,000 in gains. Age 40, 15 years in, $173,876. Age 45, 20 years in, $294,510. Age 50, 25 years in, $473,726, nearly $500,000. Age 55, 30 years in, $745,179. Age 60, 35 years in, $1,151,503. Age 65, 40 years in, $1,745,503. You put in $240,000 over 40 years. The market gave you $1.5 million on top of that for free. That's not a typo. That's compound interest. Now here's the part that should make you genuinely uncomfortable if you haven't started yet. Meet Alex and Morgan. Same income, same $500 a month, same 8% return. The only difference, Alex starts at 25, Morgan starts at 35. Table. Alex starts at 25, Morgan starts at 35. Monthly contribution, $500, $500. Years investing, 40, 30. Total contributed, $240,000, $180,000. Portfolio at 65, $1,745,503, $745,179. Difference, $1,324. Morgan invested only $60,000 less, but ended up with over $1 million less. That is the cost of waiting. It's not $60K, it's 10 times that. And here's what makes this even more striking. Alex barely contributed more money. The extra $1 million came entirely from the extra decade of compounding. 10 years of watching your returns earn their own returns. This is why the most expensive financial mistake you can make isn't a bad investment. It's waiting to invest. Okay, so where do you actually put this money? Let's cut through the noise. Fidelity, best for beginners. Zero-fee index funds, no account minimum, great educational tools, and a top-tier mobile app. Their Zero Total Market Index Fund has literally no expense ratio. It costs you nothing to own it. This is where I'd send any first-time investor. Vanguard, the gold standard for long-term investors. They invented the index fund. Their funds like VTSAX or VTI have expense ratios as low as 0.03%. That means for every $10,000 invested, you pay $3 a year in fees. Their platform is less flashy, but their funds are elite. Robinhood. If you're starting with smaller amounts and want the simplest possible interface, Robinhood works. Fractional shares mean you can buy into any stock or ETF with as little as $1. Great as a starting point, though most serious investors eventually migrate to Fidelity or Vanguard for long-term holdings. For the $500 per month strategy, here's my recommendation. Open a Roth IRA on Fidelity or Vanguard, set up automatic monthly contributions, and put it all into an S&P 500 index fund. Set it, forget it, let time do its work. One more thing before I let you go. There's a mental shortcut called the Rule of 72 that tells you exactly how fast your money will double. Divide 72 by your annual return rate. The result is how many years it takes your money to double. At 8% return, 72 divided by 8 equals 9 years to double. At 10% return, 72 divided by 10 equals 7.2 years to double. At 6% return, 72 divided by 6 equals 12 years to double. Start with $10,000 at 8%. In 9 years, it's $20K. In 18 years, it's $40K. In 27 years, it's $80K. Your money doubled 4 times. Not because you did anything, because you stayed out of the way and let time do its work. Here's your action item. Today, open a Roth IRA on Fidelity or Vanguard. If you already have one, log in and make sure your monthly contributions are automated. Even if it's $100 a month right now, start. You can increase it later. The math doesn't care if you're ready. The clock is already running.
And if you want to know the 7 money mistakes that are quietly keeping you from ever reaching these numbers, I've already made that video. It goes live next week, and it covers every financial error I see beginners make with the real dollar cost of each mistake over 20 years. Hit subscribe so you don't miss it. 1 video per week, every single week, with strategies you can act on immediately. I'll see you in the next one.